Good morning, Angus. How are you today?
Good morning, Patrick. Yeah, very well, thank you.
Okay. Welcome to all members. And again, we apologize for yesterday. I was a bit sick, and so we just couldn't make it. So we're going to do it today. So let's get started. We're just going to go through a little bit of housekeeping before we start the presentation. I will be conducting the presentation today with Angus. Please be reminded the disclaimer that all information and content that we talk about or recommendations that we discuss in this presentation is for general advice only. Before acting on any of the recommendations or advice in this presentation, we recommend you seek financial advice from a financial planner or consultant on your behalf. Comments and questions, you can ask questions at any time throughout the presentation, and we'll endeavor to answer as many as possible. Just place your comments here where you can see where the orange arrow is, and we'll endeavor again to answer any of those questions that you have to send through. If you cannot hear the presenters and you cannot listen to the webinar, you're having technical difficulties, please call the office on 1-300-88-1177, and one of our representatives will help you get connected to the presentation today. So that brings us to the market update. And Angus, we must say it's been a pretty busy week. It's been an eventful week in the markets. There's been a lot of things unfolding. I thought we'd start with the S&P 500 correcting back to our target of 4,200 at this stage.
Yeah, look, it certainly has been quite an eventful week. We've had bond yields breaking out on the top side over the last couple of weeks, moving in tandem now with higher oil prices. So they're moving together, and we saw some, real pressure come through on those mega cap tech stocks and the growth stocks. So that, the NASDAQ 100, had the biggest decline since March. And we also saw, a corresponding sell-off in the S&P 500 and the Dow. The correction to the downside in the S&P and the Dow, probably not quite as much as the NASDAQ, which is what you'd expect, given that those benchmarks have a lot less interest rate sensitive constituents than the NASDAQ does. So yeah, fairly eventful week. Obviously, following on from Jay Powell's press conference comments he made last week, we've seen that upward pressure in the bond market. The S&P 500 broke support. Interestingly, quite a decent upside reversal happened on Wednesday. The index got down to, the SPX got down to about 4230. Yeah, very close to our target of 4200. It was a decent upside dynamic. So, the near term, it remains to be seen which, where the S&P 500 goes. If we got good inflation data out tonight, a bit of a back off in the bond market and the oil price backing away from the, from the mid 90 levels, we might find that the S&P 500 has seen the lows during this near-term sell-off. But of course, if the inflation number comes in hot, we see another move to the top side in the bond market, and the oil price reasserts to the top side. I think we could see some more downward pressure. So yeah, it has been quite eventful.
So you're still looking for the 4,200 level here, Angus? Is that correct?
Well, I think I think the S&P 500 sort of touched that level this week. So near term, this sort of September correction might be over. We've got to just keep focused on the bond market and what those treasury yields are doing, and we've got to stay focused on the oil price, because obviously, the higher oil goes, it feeds into the inflationary narrative, and I think that's one of the reasons why we're seeing one of the factors behind those higher bond yields. Now, this is an interesting chart of the NASDAQ 100. I think there's more downside risk in the NASDAQ 100 simply because those mega cap technology stocks led the market to the upside. for most of this year. They're now sitting on huge valuations. They've got a lot to live up to and deliver in the upcoming September quarter reporting season, which gets underway in about 3 or 4 weeks' time. As we can see on this chart, whilst the S&P 500 touched that big breakout level, the NASDAQ 100 still has quite a lot of scope to fall further, I think. So I think the corrective move in the NASDAQ 100 is just getting underway. I think it's got further to go on the downside. 13,200 is our target, and which would represent a 50% retracement of the move from the October lows. And, and as we've been talking about, I think this is all about expensive multiples, PE multiples. We've seen the multiple on the NASDAQ 100 expand for most of this year, which hasn't been accompanied by earnings growth. I think it's about those multiples just becoming too rich, colliding head on with higher bond yields. And, we've seen this big upward movement in the US bond yield curve. It's been quite historic, really. You don't often get huge moves in the US bond market. Maybe we could put a slide of the bond market up. That's crude price there. That's energy stocks. So this is a slide of the bond market, and we had this big consolidation when the US 10-year hit 4.2 in July and in October last year. Since breaking out, it's surged to 4.6, currently trading at 4.54. So these US 10-year bond yields are trying to find and establish a new range. I think it's fair to say that in terms of what I guess I'm sort of thinking technically is that 4.2% now becomes the new floor. And of course, we just now need to know what the new ceiling is going to be. Is it going to be 5.6? Is it going to be 5.8? Or is it going to be 4.8? Or is it going to be 5 plus something percent? And I think this is going to provide the key to where the stock market goes over coming months. And as I put in my note this morning, the caveat is, whilst the S&P 500 looks like it might have found a near-term floor and be ready for a rally, all bets are off. All bets are off if that oil price moves up towards 100 plus a barrel. And if we can put the WTI crude price chart up, yep. And if those US 10-year Treasury yields keep climbing. So that's what I'm focused on. And, we're going through quite a dynamic change in the bond markets, which arguably are normalising in terms of the yields. They're normalising after coming out of a long period of financial repression, and they're just re-establishing themselves into higher trading ranges, which also reflect higher rates of inflation. This chart of WTI crude, I think this was quite interesting. We saw the prices lift into the mid-90s. It touched 95 US a barrel yesterday. That was certainly my near-term target. So we could easily see some backing and filling now and a bit of consolidation. But, the upward trend is there. I was writing about the demand and the supply dynamics. We've seen, OPEC reassert itself really in the driver's seat now in terms of the price maker, and those production cuts that they've implemented have really worked. And I think what is telling about those production cuts is that in the past we would have seen a much faster and quicker and dynamic supply response from the West, from the United States. We're not seeing that, and I put that down to the fact that the political appetite's just not there for new energy projects. We're seeing, the shale energy boom that we had in the last decade, that's pretty much peaked. The US is not able to crank that up and to the same degree as they were. And of course, with climate change, the public just don't want, anything, more to do with new large fossil fuel projects. So OPEC is in the driving seat. And the narrative, or that I should say the consensus narrative is, and the assumption is that OPEC won't want to kill the goose that lays the golden eggs. They won't want to jack the price up to the point where they tip the world economy into a recession like what happened in 2007. But we can't make that assumption. I don't think we can just generally make that assumption that that they're not going, that they're just going to crank up supply and bring prices back down. I think that's I think that assumption is flawed with risk. They instigated. Sorry, Pat.
Yeah, we're seeing the stockpiles of oil in the U.S. dropping quite a bit. I know you were writing a little bit about that today in your note. I mean, that's going to have a big impact on what's happening with the oil price, don't you think?
Absolutely, absolutely. And we're already seeing refining margins and crack spreads blow out, which basically points to higher petrol prices, higher gas prices down the line. And of course, I guess the other point is that we didn't see elevated energy prices in the Northern Hemisphere winter, December, January, February last year. It was quite a mild winter. But, if this winter turns out to be different and it is colder, it just sets the energy markets up for a spike. And of course, we're not just seeing this bullish technical setup in oil. It's also happening in a lot of other sectors of the energy markets. I'm seeing a technically bullish setup in uranium. Uranium prices at the highest level in years this week. We've seen a big move in the uranium stocks. Coal prices have reasserted to the top side. I don't like talking about coal. It's bad for the environment. I get all of that. But China and India are using records amount of coal to shore up their power grids and their base load. So it's no surprise. We'll put this chart up. This is the ASX. I think this is the ASX Energy Index. Actually, this is it's the same sort of technical setup. This is actually the Spider Energy ETF, or XLE, which is it's a basket of stocks that comprise the world's largest energy companies. And we can see on this chart that XLE is clearly broken out today from a multi-year range. So, the bottom line is, I think, stock markets, I'm still cautious. We're still holding plenty of cash. In the Global Contrarian Fund and the Global High Conviction ETF, we've actually got a hedge on via put options over the NASDAQ 100. But I'm bullish on the energy complex. I still like the precious metals. And as we've seen with these energy stocks, they're all beginning to break out. So this is becoming quite a ubiquitous trend around the world. It's not just ExxonMobil. We're seeing bullish technical patterns developing. Shell, BP, Woodside, Santos in Australia, Inpex in Japan. It's across the board.
So they'd be your preferred plays in the oil market at the moment, would they? I mean, Santos, Woodside, and the others that you just recommended there.
Yeah, I like the big large producers that are generating lots of cash flow, paying big dividends to the shareholders. That they've got the production, and as those spot oil prices increase, that's flowing straight through to their bottom line. And we saw the energy sector really derate for most of this year, and a bit of last year as the oil price came off the boil. And I think we're now seeing the leadership in the global stock market, not just in the US. I think this is a global trend. I think we're going to see this happen shortly in Australia. I think the leadership is going to come back to those energy stocks. And as we see with this chart of XLE, that there's been an historic breakout. So yeah, I think the energy stocks are all going to run. And I put a chart in this morning of the ASX 200 energy index, which looks very similar to this chart that we've got in front of us.
And you're thinking that's on the cusp of an important breakout, the ASX energy sector at the moment.
Yeah, I think they are on. It hasn't actually confirmed it yet, but it's very close. Very close.
Okay, we've already spoken about the bond yields, so we'll move on here. Gold, something we've been talking about a lot, and gold facing near-term pressures from dollar strength. Where do you see the US dollar and the gold price heading at the moment, Angus?
Well, I think it's worth highlighting that we've seen the volatility in the gold stocks this week, and it is they can be quite volatile, but a lot of that's got to do with the fact that the US dollar has been rallying. But if we look at it, gold in local currency, it's a completely different story. I mean, this chart here is got a very bullish technical setup. It's of the euro, gold and priced in euro. It looks like it's about to break out above the record high of 1850. It's very close. And, we can just see how consistent it has been. The same story is true for the Australian dollar, Japanese yen, gold price to Japanese yen. So for a lot of the gold producers, in local currency terms, they're actually making huge free cash flows at the moment. And, of course, the US dollar gold price came off this week as the dollar index broke out. We saw the index, since breaking above that 105 resistance level, it's extended higher. It's probably headed back up to sort of 108, 109, depending on what the bond market does. I think if the dollar were to get to 108, 109, you'd have to see US Treasuries move probably another 40 to 50 basis points higher from where they are at the moment. I think the interesting point really to make about the gold price and the dollar, in the past when we've seen a significant move higher in the greenback, which we have, this year, you'd expect gold to be down a lot more in US dollar terms. And it's down, but it's not down as much as historically what it would have been. And I put that down to the fact that there are other demand factors at work now in the global precious metal market. I think any sort of weakness in the spot gold price basically draws in the central banks, and the central banks have become quite prolific buyers. And some months they buy more than other months, but it's definitely a secular trend that's underpinning the gold market. So I guess where I'm going with all of this, Pat, is I don't see the US dollar going back to its record high. And I don't see the index getting back up to 114. In fact, I see the rally in the US dollar rolling over and stalling sometime in the next 1 to 2 quarters. And then I think the US dollar starts to head back down again. And it'll be at that point that we really see some potential fireworks in the US dollar spot gold price.
Okay, and with the inflation numbers, I mean, do you think inflation flips off the leash again? And what would happen if it does?
Yeah, I think it's going to be very sticky, Patrick. I don't think it's going back to 2% anytime soon. I agree totally with Bill Ackman on that one. And I think the second wave of inflation, it's probably not going to get back to where it was at 10% or whatever it was. It's gone up to 10%, 9%, 8%. I don't think it's going back there, but it's not going back to 2% either. And it's going to ebb and it's going to flow, and we might see a surge in CPIs, in the next few quarters. We could easily see it surge, and I'd probably put that down to commodity price inflation. Just as commodity prices set it off last year. Really, that was one of the catalysts. I think we're going to see a rise in commodity prices. What was really interesting, I didn't write about this morning. I didn't really have any time, but it's a theme I want to pursue. But it was an interesting conversation on Bloomberg about the US, which has historically been a big big food exporter to the rest of the world. The US has always grown a lot of food, a lot of grain, a lot of corn, a lot of soft commodities, a lot of cattle, a lot of beef. For the first time in history, I think the US is set to become a net importer. And I think climate change, fluctuations in rainfall levels and droughts and flooding and all the rest of it, I think it's playing havoc with the global food supplies. So, look, I think it's not just going to be about energy prices, but I think it'll be higher food prices. And of course, that as we're seeing, that feeds into wage inflation and fuels a wage price spiral. It remains to be seen what's going to happen in the United States with this UAW auto union strike. I mean, the market quite liked the progress that was made, which essentially they were demanding a 40% increase, and they've now dropped that to 30%. But can you imagine a 30% increase and the cost of labour in Detroit in terms of what that's going to mean in terms of new car prices? So I think inflation it proves very sticky and coming down. I think it's going to be with us for a long time, and the name of the game really is to have thematics in your portfolio that are going to benefit from inflation. I think commodities are a natural hedge. I also think the Japanese banks, which have done extremely well this month, which Japan as a nation benefits from inflation, unlike a lot of other countries, given that they've had years of financial repression and economic deflation. But also those banks, which are now beginning to make some real margin after more than a decade of having 10-year rates squashed down to 0.1%.
So if we're going to have sticky inflation, oil prices going up, commodity prices up, food prices up, where do you think we're going with interest rates? Do you think interest rates are going to go up again one more time? And do you think that'll be it? And they'll probably stay higher for longer than everybody thinks? Or do you think we'll see the interest rates starting to come off next year?
So there's a lot to unpack there, but just quickly, I think, look, near term, it's going to be driven by, comments from the Fed and the data. So, tonight's PCE inflation print is going to be an important one. That's the key inflation measure that the Fed follows. If it comes in hotter than expected, then it's, we're going to get another leg up in bond yields. If it comes in better than expected and it comes in cold, bonds could rally. But I think, looking out over the medium term, and by the medium term, I'm talking about the next sort of 3 to 12 months, whilst the global economy is in expansion mode, we're going to see those bond yields continue to ratchet higher. That's my view. And I think, Bill Ackman's comment today on CNBC that, he reinforced his view that the 30-year is going to 5.5. I think I think that's right on the money. I would be positioning for that. Now, looking out over, looking out over more than, say, 6 to 12 months, you'd think that the rate tightening that the central banks have put in will slow the economy, will go into a recession or at least an economic slowdown. And under that scenario, we will eventually see bond yields start to come down. My big point is that bond yields are now in a secular bear market. We had this big secular bull market that went for 4 or 5 decades when interest rates topped out at 18%. We've had a major inflection in the last couple of years. And we're going to get rallies, peaks and troughs, but the trend is going to be higher. So, I think bond yields over the longer term are headed higher, back to a more normalised trading range.
Okay. If I get to a few questions that are coming through from the members, Angus, one question is on the Japanese equity markets and the banks. And I know you touched on that a little bit, and I know you've been quite bullish there. and you've got quite a bit of exposure to the Japanese banks in the global ETF and the contrarian fund.
Look, I think the Japanese banks are just a great natural hedge against higher interest rates and inflation. I mean, Bill Ackman put he put a short hedge over the 30-year Treasury. I think the Japanese banks are the way to go because, number one, they're cheap on a price to book basis. Those valuations were compressed through decades of financial repression in Japan and deflation, and 10-year yields are trapped at 0.1%. So that's all unwinding. So I think this cycle, for the Japanese banks, I think it's got a lot further to go. They're still cheap on an historic basis. They don't have the same sort of bubble-like or the same sort of price growth risks in the housing market as other nations do, such as Canada, Australia, and other countries around the world. And they're doing a lot more now for the shareholders than they've ever done in the past. They're being a lot more proactive in terms of returning capital to shareholders through buybacks and higher dividends, etc., and unlocking cross shareholdings in each other. So I still think they've got further to go, a lot further to go. I'd just be struggling to buy them today. Given the big run that they've had, I'd probably try and wait for a pullback. And I like Japanese equities generally anyway. They've had the mother of all bear markets. We've only really just seen the Topex and the Nikkei get back to where they were trading in 1989. So further to go. I just think you've just got to pick your time.
Okay, just circling back to oil. What do you think happens if OPEC doesn't raise supply of oil growth above $100? I know you touched that on in your daily today.
Yeah, I've read a lot of reports. I've read a lot of analysis around this, and the consensus seems to be that the world will be able to handle. The world economy will be able to handle, 100, 110, 115 a barrel, but not much beyond that. My personal view is that we're already seeing it becoming a bit of a headwind. If it gets above 100, I think, I think that then becomes quite a bearish narrative for the markets. Just as we saw the oil price really break out to the top side and that late cycle move back in 2007, which pushed the global economy and the US economy into recession in 2008. The same could happen. But we just don't know what OPEC are going to do. I mean, as I sort of noted this morning, you'd think that they would increase supply to the global economy to keep oil prices within a range. You'd like to think that, but we just don't know. And as we saw in the 1970s, when they had that pricing power, they instigated a couple of price shocks to the world, which set off inflation in the 70s. And they have that pricing power back today. That's the scary thing.
So if we look at your positioning of the funds, the managed accounts at the moment, you're still positioning relatively defensively in the energy sector and material sector, and you're still holding some cash there. What type of cash levels are you at this moment? It's just one of the questions we're getting from members.
Just on our energy positioning, I mean, if you look at the energy sector in 1980, it was about 20-25% of the US stock market in terms of market cap. Today, it's much lower. It's about 5 or 6%. It's a lot lower. That's not the exact number, but it's much lower than 25%. So, there's scope for the energy sector to outperform relative to the rest of the global benchmarks. And so I think there's a significant re-rating for the sector coming. So we're overweight in that. We're still carrying between 10 and 15% cash in our portfolios, which I think is prudent, given that we could see some volatility coming through in the stock markets. If there's, if some of these risks materialise, i.e. the oil price going through 100 and the 10-year bond yield surging above 5, these are all potential pressure points. So I think 15% cash is prudent. I know gold's been hard work and it is volatile. I take solace from the fact that we mainly own producers that are generating decent free cash flow in local currency terms. And whilst they are volatile, we just don't know when the turning point's going to come in the dollar. And what we've typically seen happen in the past, the gold price moves well before the top's in on the dollar. So, you've got to be quick for these inflection points. So I just want to make sure that we're there. A lot of the investment banks have raised their price targets to, 21, 2200. I still like uranium. Obviously we have a little bit of coal in our portfolios, which, doesn't sit well with me politically, but, they're incredible cash flow generating machines, and there is going to be a gap between when the world can move off fossil fuel fired power onto renewables. But the one that I really like is uranium. And I think that nuclear energy is going to make a huge comeback over the next 5 to 10 years. It's already in train. There's countries such as India and China, they've just got no choice really but to go and build nuclear modular reactors to try to shore up their baseload and get their pollutants and the carbon emissions down. So that's pretty much what I like, what we like at the moment. Sort of nibbling on a few bit of China exposure. I think there's a big inflection point coming in China and Hong Kong. Those markets are just not there yet. They're not going down as much as what they were. They're not going down. The downward momentum is dissipated. Those markets are no longer going down and reacting as much to bad news. So I think a bottom is being forming, and they're consolidating ahead of a topside breakout. But it's just hard to pinpoint the timing on that.
And I got a question here about the ETF, the global ETF, and just kind of what are your key themes that you're using in the ETF at the moment?
So if I just do a quick recap, where Japanese financials are one of our largest exposures. We've got global energy stocks, and by that I mean oil and gas. We've got a little bit of coal, and we've got a lot of uranium. So we're all over that thematic. We've got precious metals, and we're diversified across the board really, but I've got a bias towards the Australian gold producers because, Australian dollar spot gold price at 2,950. A lot of these miners are actually making really good margins and generating good cash flow. So I like that sector, and we have started to nibble away on a few of those large Chinese internet stocks, mega cap internet stocks, but we only have a moderate position in China, and that's something that we could potentially look to add to once we get confirmation that an important inflection point is in for the CSI 300 and the Hang Seng, and that we're out of that bearish downtrend cycle that began a couple of years ago.
And to get exposure to the Japanese banks, what do you think is the best way to do that?
Look, I'll probably use ETFs, which tend to be a basket. What we own the major banks. We own things like Sumitomo Mitsui Financial Group. That's our largest position. Also got which is one of the largest banks in Japan. We also have a big position in Mitsubishi UFJ Financial Group, Mizuho, and a couple of the regionals. I quite like Resona and Chiba in Japan. We also really like, obviously I like Sony and Nintendo. We don't hold those in the ETF, but we hold those in the SMAs. And one stock which we hold across the board is Inpex, which is the largest oil and gas producer in Japan.
What about the casino stocks at the moment, Angus, in China?
Yeah, I don't like the casino stocks in Australasia, and I don't like them in the United States really either. But I think they're looking quite interesting in China. And given that, we've heard all the bad news about the Chinese economy, but people are still spending over there. And there's a lot of pent-up demand for gaming. We've got the upcoming Golden Week where, China literally shuts down for a week of public holiday. And it will be interesting, but I suspect that these Macau casino stocks are actually going to go back to generating even more revenue than what they were doing before the pandemic. And yet their share prices are still 70, 80% down from their peaks. So I think that space is looking really interesting. And I've put a couple of charts in on MGM China and Wynn Macau for those members who want to have a look at those. In the daily, I posted those in the last couple of weeks. And I think, they're all sort of closing in on quite important topside breakouts.
Okay, well, that kind of wraps up all the questions that we got at the moment. I just wanted to remind members that next week we're on a publishing break. Angus, you're going to take a break, much deserved break for a week, and I think you're traveling. So I wish you a safe trip. And just to remind all members, we will not be publishing the daily next week, and we will not be publishing recommendations next week. We have our normal publishing break. So Angus, have a good break, have a good rest. Thanks for all the members for joining us today. And where are you off to, Angus?
And I'm with Mrs. Geddes in Vietnam, and we are in Ho Chi Minh City. We're here for the food. We love our Vietnamese food, and there's some great restaurants which we're going to visit. And then we're heading up to Da Nang and Hoi An for a bit of the beachside action for the rest of the week. So yeah, looking forward to that.
All right, well, have a great week, and to all members, have a great weekend. It's a long weekend coming up. Everybody stay safe, enjoy the weekend, and we look forward to reconvening with you not next week, but the week after. Thanks again, and have a great weekend.